As a private money lender, I get all kinds of funding requests. Most notably, transactional funding comes up a lot. For those of you who don't know me, I'm Anitra Preston, co-founder of Vertical Capital. We lend money to real estate investors in New Orleans. In 2020, Elridge and I started lending money with just $14,000. Today, that $14,000 has grown into a $2 million lending portfolio. If you are in New Orleans or Baton Rouge and need a loan, hit us up. If you are an investor looking for some passive income, then click the link below. We should talk. When someone asks for transactional funding, the ask is general and not always clear. You gotta understand there are about 3 types of transactional funding. And today, I'm gonna break them all down so you can determine if you want to lend on them or not. I'm also going to show you how you can offer a loan product that can give you a 14% ROI in 30 to 90 days. So you might want to stick around to the end. So there's EMD funding, which is earnest money deposit. There's double closing funding, and there is gap funding. As a real estate investor since 2004, a licensed real estate agent since 2014, and with over 50 million in real estate transactions, there may be a few more out there, but in my experience, these are the most common. So let's look at them each a little closer. First up is EMD, or earnest money deposit. Before I go into what EMD is, let's talk about who would be asking you to fund their earnest money deposit. That person is typically a real estate investor. This could be a fix and flipper, a wholesaler, or someone buying a rental property. Now the question is, why would a real estate investor need funding for an earnest money deposit? If you're going to be lending or you're going to be a lender, I don't care what you're lending on, the why is an ask you can never not ask. Even if you may know the answer, I like to hear it from them. It's no different than asking a fix and flip investor why they ran out of money on their project. You are listening for red flags. It is during this conversation that you will discover if the person is a seasoned investor, an intermediate investor, or someone you should just completely avoid altogether. A wholesaler who is asking for EMD funding may be new or newer to real estate and may not have built up enough cash to fund this part of his business. A new wholesaler may also lack the skills required to see the deal to close in a timely fashion, or it could fall through for several reasons. This may leave you with some exposure if you do not have the proper training or the protections set in place to protect your capital or your investor's capital. But there are some seasoned wholesalers out there, pretty good ones, that typically wouldn't even ask for this type of funding. How do I know? Because my partner Elridge was once the #1 wholesaler in New Orleans. Before doing this video, I asked him, how much on average did you put down for your EMD deposits? He said 0, because he had built up relationships with a few title companies throughout our city. You see, when you bring them enough business and a proven track record to close deals, let's just say you have a network of favor. Now, if you yourself are new to lending or real estate, this doesn't mean getting with the seasoned wholesaler or investor is bulletproof. In fact, without the proper training, this could possibly come back and bite you in the derriere. Why? Simply put, they know more than you, and they know how to play the game to get in and out of situations and circumstances when it comes to the actual transaction. So be careful. A fix and flipper may need the EMD funding because they simply do not have it. The typical response is, all my available cash is tied up in my current project or projects, and I saw this deal and I can't let it go. They may have financing in place, like a line of credit from a larger institutional hard money lender, or they may be confident they could raise the capital to close, or they may be in the middle of a refinance and have set the closing for the deal they are trying to buy after the refinance closes. So their money is on the way. It's like they want to ensure you they have the capacity to pay you back in the near or immediate future, although they don't actually have the cash right now. It sounds good, but the control is not yours or theirs. All the control lies in the hands of the refinance company. So the question you gotta ask yourself is, how much control are you willing to give up? Drop your comment below. I'd love to see your thoughts. The same is pretty much for the real estate investor buying rentals. Their why is along the same as the fix and flipper. Typically, when I hear this as a lender, my head begins to roll because all I heard is I'm overextended and I'm moving too fast. And I generally equate this to a borrower not considering the risk involving our investment because the money isn't theirs. And all he sees is getting the next deal, even if it means an overextension. And most lenders won't waste resources on trying to recover $1,000 or $5,000. The cost and time will outweigh the recovery every single time. This is one reason why most lenders do not fund EMD. I also question their money management skills. If your business is fix and flip or rentals, this means this is what you do all the time, right? So why don't you have the cash reserves set aside for you to continue to operate your business? As a lender, yes, you are in the business of lending, but you are also in the business to shift the risk away from you and to the borrower so you can grow your business. You make your money on the loan structure, not at the closing table. Yes, of course, you can collect a lot of fees at the closing, but until you get your principal back and it's returned unscathed, you ain't did nothing yet. Hey, if you like these golden nuggets that Elridge and I are dropping all over YouTube, and you want to be on our weekly newsletter, then join our free community. The link is in the description. Okay, so we have discovered the who and the why. Let's explore what an earnest money deposit is and its function in a real estate transaction. In simple terms, an EMD is the dollar that the buyer or purchaser puts down on a purchase agreement, thus securing or binding the contract. In addition to signatures, it lets everyone know that the purchaser is acting in good faith to perform on that agreement as agreed. In other words, he's moving towards purchasing the property. This can be any dollar amount. It can be as low as $500 or as high as mutually agreed between the purchaser and sellers. In seller financing situations, the seller may dictate the specific amount that is required for the borrower to put down as an EMD. It is usually on the higher end since the seller is providing the financing. The EMD should always be held in escrow with a title attorney or a title company. These companies have been vetted by your state and have met the minimum requirements to hold an escrow account. Never ever give money to either party in a real estate transaction other than the title company. This EMD goes towards the purchase price or the sales price. For example, today you write a check to the title company for 123 Magazine Street, any amount of $1,000. On the date of the closing, the $1,000 is subtracted from the final closing cost. So if the final closing cost is $75,000, then you will need to show up with $74,000 to complete the transaction. Now let's talk about, should you be lending on EMD? As a lender, every time I look at a deal, my question to myself is, how can I be creative? How can we lend on this deal? How can I shift risk away from myself and shift more risk to the borrower? This is exactly how every banker in the world thinks. And if you plan on being a lender, then you definitely should adopt this same mindset. I can honestly say I have never loaned on EMD. For me, this is the most riskiest position along with a down payment to place your money. It's generally not secured to anything, and if the purchaser is found to be negligent in his duty to perform on this purchase agreement, then the EMD is at risk of being kept by the seller. There may be a way to secure this, but I honestly don't know. as I have never considered lending on EMD. Personally, it just raises too many red flags for me. I suppose if you're dealing with an exceptional investor who has some collateral, you might consider cross-collateralization, but the dollar amount is so small, it's simply not even worth the hassle to me, even in preparing my docs. But if you are considering this, make sure you get the proper education and ask the right people the right question. Okay, next up is double closings. These are common in real estate and happens all the time. As we discussed before, all three investor types may need to use this strategy for various reasons. A wholesaler may need to close on the property from seller A because he doesn't want his assignment fee revealed to the end buyer. And maybe he wasn't upfront with seller A that his intentions was to wholesale the property to another buyer. Regardless as to how you feel about this, those are generally the most common reasons, and there may be more, but this has been my experience. Now, a fix and flipper and a person who is buying a rental property, their reasons may be a little different, which may not necessarily require a lender like myself. Either one of these parties may be waiting on proceeds from a refinance by which those proceeds will be applied to the purchase of the new investment property. Just this past March, we sold a double or a duplex to a rental investor in this exact same way. At 12 p.m., he closed on his refinance. That money was wired into the title company. Those funds were applied to our deal, and the check was cut to us, and by 1 p.m., it was all over and done with. So, in short, a double close simply means you are closing on two properties at the same time, either a sale purchase or a refinance purchase. Or a double close could mean you are closing on the same property twice in a short period of time. It usually flows like this. You have one property, 456 Magnolia Street. The seller sells that property to buyer A. That transaction is completed at 1 p.m. At 1:15, buyer A becomes seller B and sells that same property to buyer B for a profit. If you are considering lending on double closings in this manner, then your loan is placed on the first transaction, and then it is paid off on the second transaction. Now, on something like this, I absolutely would lend on this all day long. Generally, a seasoned wholesaler is getting these properties at a deep discount. Number one, my money is only out for 2, maybe 3 hours, thus shrinking my risk from a normal loan term of 12 months to a loan term of 2 to 3 hours. My rate of return is stupid crazy. Plus, it stayed secured in escrow the whole 2 to 3 hours. And I secured my money with the collateral and a lender's policy. This is a no-brainer for me. It doesn't get any better. So yes, I absolutely love these. Depending on how much room is in the deal, we would even consider 100% financing. And this leads me to how you can grow and compound your money really fast if you are just starting in lending without a whole lot of cash and maybe you don't have a lengthy track record. One of our first loan products was the vertical capital wholesale loan. It was specifically for wholesalers, but later we opened it up to new investors who were just getting started. It's this loan product that boosted our capital really quickly. It was a flat fee. It was 14%, no monthly payments, and we did this loan for about 3 to 4 months per an investor. Right? It encouraged the wholesaler to get even better deals. The lower the deal, the less out-of-pocket costs to them. We would do 100% financing in most cases. It also gave the wholesaler the opportunity to make bigger spreads because they actually bought the property. And most would list to the general public, which is 97% of any market, for higher profits, instead of just marketing to their buyers list, which is no more than 3% of the market. So the structure was the investor got a really smoking deal that we knew was smoking, and they were confident that they would be able to sell that within 90 days or less. They would do no repairs, if any were even needed, and we would fund 100% at a flat rate of 14%. So no matter if our money was out for 30 days or 90 days, our return was 14%. So on day one, if the investor borrowed $100,000, my loan payoff would be $114,000. Or on day 88, it would still be the same $114,000. Now, why would an investor do this? Simply put, it keeps whatever cash they have in their pockets so they can keep moving forward. They can keep moving their business forward. It's called opportunity cost. You might not attract the most experienced investors, but with the proper underwriting and protections, it's definitely a boost. You know what? Elridge, you think we should reopen this product? If y'all think we should offer this product again, drop a comment. Let's see what you think. Our capital partners certainly loved it, and we're very disappointed when we stopped doing it. Next up is gap funding. This is when a fix and flipper or rental buyer wants you to lend on maybe the down payment, and maybe they got 80% financing on the deal and want you to cover the other 20% and or the closing costs. The 80% can be with a traditional lender, or it could involve seller financing too. This way, they get 100% financing. Some investors view this as savvy. So I'm a lender. And for me, I'm looking at it as how can I have the least amount of risk possible in this position? With gap funding, you are generally lending in second lien or junior lien position. This is important to note because in second lien position, you don't have control if something goes south. The first lien position holder holds all the cards. If they foreclose, they are in primary position to get paid first, and you get what's left. And that might not be enough to make you whole, and you're forced to pursue the borrower personally, if you have the proper paperwork in place, of course. Gap funding could extend to construction or rehab costs. Maybe the lender didn't fund 100% of the construction or rehab. If this happens, the deal may not be as good as the investor thought. And this is just the lender's way of reducing their risk. Or the borrower simply doesn't have the funds to start the project. Or maybe there was some cost overruns and they need more cash to complete the project. Now, as far as the latter, this may be a bit risky because once work has already been started, a lot of lenders don't like coming behind work started due to the potential of mechanics and materials liens. And you are already in second lien position to the primary lien holder. For these exact same reasons, gap funding can be very, very profitable as it justifies a much higher cost. In other words, you can charge higher than your normal rate than if you were in first lien position. With the proper training and structure, this can yield you a lot of wins. We don't mind doing this provided there is enough room in the deal and the borrower can meet some very specific criteria. This is doable, but you gotta set this up perfectly. So far, we have covered 3 different types of transactional funding: EMD, which is earnest money deposit, double closings, and gap funding. These 3 are the most common. 2 out of the 3 I'm a proponent for. And with the proper training and deal structure, you can make a lot of money. As for EMD, my knowledge is limited in regards as to how you could mitigate your risk on this. I also feel very strongly that if the investor does not at least have the EMD for their deals, which for us in New Orleans could be anywhere from $500 to $2,000, maybe $3,000. But after wholesaling 35 properties and listing 40 in a single year, I've probably only been a part of less than a handful of transactions that the EMD was over $2,000. It's just a red flag to me, and I can't ignore it. Hey, listen, if you like what we're doing here on YouTube, don't forget to like and subscribe. This actually concludes the video, and I'll see you on the next one.